All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to walk you through is not fear-mongering, it is not clickbait, and it is not the kind of noise you hear from someone trying to sell you a newsletter. This is about a legal architecture that was quietly expanded layer by layer without a single major headline that now places your bank account at the center of the most aggressive financial surveillance regime the United States has ever operated in peacetime. And here is what makes this different from every other conversation you have heard about government overreach. This is not coming. It is not proposed. It is not stuck in some Senate committee waiting for a vote. The infrastructure is already deployed. Your bank is already reporting to the federal government. The question that most people have not stopped to ask is not whether they are being watched. The question is what triggers the next level of scrutiny, and whether you are already in that category without knowing it. Let me be precise about what is happening right now and why the window for acting on this information is closing faster than most people realize. Under the Bank Secrecy Act, which has been federal law since 1970 and was significantly expanded by the USA Patriot Act in 2001, your bank is legally required to function as a financial intelligence node for the United States government. That is not an opinion. That is in the statute. Your bank files currency transaction reports with the Financial Crimes Enforcement Network, known as FinCEN, for every single cash transaction above $10,000, not just suspicious ones. Everyone. And if your bank detects a pattern of transactions it cannot explain, it files a suspicious activity report, a SAR, on you, without telling you, without your knowledge, without your permission. And by law, your bank is prohibited from disclosing to you that a SAR has been filed. Federal statute makes that a criminal offense for the bank employee who tells you. That is not theory. That is 31 U.S.C. Section 5320. And here is the number that should make you stop and reread this sentence. In fiscal year 2025, IRS Criminal Investigation identified a staggering $10.59 billion in financial crimes. That is a 15.7% jump from the prior year. Tax fraud alone represented $4.5 billion of that total, which was a 112% increase from the year before. The machine is not slowing down. It is accelerating. In the next few minutes, I am going to walk you through exactly how this surveillance architecture functions, why the recent operational expansion by FinCEN and IRS Criminal Investigation represents a structural shift rather than a temporary enforcement cycle, and most critically, what the historical precedent tells us about where this ends and what you need to do about it right now. Before we go deeper into the mechanics, you need to understand the framework through which everything I'm about to tell you should be filtered. I call it asymmetric exposure. Most people think about their bank account as a place where money sits. Safe, accessible, yours. But legally, your bank deposit is a liability on the bank's balance sheet. You are an unsecured creditor of that institution. And in the current regulatory environment, that same account is simultaneously a passive data stream flowing directly into federal databases that are now being processed by artificial intelligence and high-performance analytics systems at a scale that did not exist 5 years ago. The asymmetry is this. You have almost no visibility into what your bank is reporting about you, no way to see your own SAR if one exists, no notification system, and no right to contest a report before it is filed. The government, on the other hand, is building decision-grade financial intelligence from your routine transactions at a scale that most people cannot comprehend. That is an asymmetric information position. And historically, when that kind of asymmetry exists between citizens and their government, the citizens who do not understand the rules of the game are the ones who get caught in the machinery. Let me explain how that machinery actually works, because the operational details matter. To understand where we are right now, you need to understand where this started. The Bank Secrecy Act of 1970 was created in the aftermath of the Cold War drug trade. Congress wanted banks to be more than places where money was stored. They wanted banks to be a first line of defense against money laundering and organized crime. The original statute required banks to file reports on cash transactions exceeding $10,000. That threshold was set in 1972 through Treasury regulations, and it has never been adjusted for inflation. If you adjust it, $10,000 in 1972 is equivalent to roughly $74,000 today. The threshold was not kept low by accident. It was kept low deliberately because a low threshold casts a wider net. Over the next 3 decades, the reporting system expanded quietly. The Annunzio Wiley Anti-Money Laundering Act of 1992 introduced the Suspicious Activity Report and included the gag order provision that prohibits banks from telling customers when a SAR has been filed. The USA Patriot Act of 2001, passed in the immediate aftermath of September 11th, expanded BSA requirements dramatically, extended them to a broader range of financial institutions, and required banks to establish comprehensive anti-money laundering programs with internal monitoring systems capable of detecting behavioral patterns across customer accounts. That last point is critical, because what the Patriot Act created was not just a reporting requirement, it created a mandate for banks to build internal surveillance systems. Banks were now legally required to analyze your transaction behavior, compare it to expected patterns for someone in your demographic and industry, and flag deviations. The software that does this runs continuously on every account in the bank, every day, without anyone manually reviewing it until something gets flagged. Now let us bring this into the present, because what happened in late 2025 and into 2026 represents a step change in the operational deployment of this infrastructure that most people have completely missed. In December 2025, FinCEN launched a data-driven border enforcement operation targeting more than 100 U.S. money services businesses operating along the southwest border. What made this operation unprecedented was not the target, it was the method. FinCEN explicitly stated that this operation was built on a review of over 1 million currency transaction reports and 87,000 suspicious activity reports. Let me say that again. 1 million CTRs, 87,000 SARs, processed and analyzed systematically using what FinCEN described as high-performance data processing capabilities. The result was 6 notices of investigation, dozens of IRS examination referrals, and over 50 compliance outreach letters. The agency is now running industrial-scale data analytics on financial surveillance reports. This is not a department of 20 bureaucrats reviewing flagged accounts by hand. This is a machine learning-enhanced financial intelligence system capable of identifying patterns across millions of transactions simultaneously, and it is not being reserved for cartel-linked money service businesses. The same IRS Criminal Investigation Division that processed those reports has its own parallel expansion underway. In fiscal year 2025, IRS CI executed 25% more search warrants than the prior year. Prosecution referrals to the Department of Justice increased by 14%. Agents seized over $800 million in assets. And IRS CI launched 2 new institutional programs, CI First and the Optimizing Financial Records Request Project, both of which are specifically designed to accelerate how IRS Criminal Investigation accesses bank records and processes financial surveillance data. CI First is particularly significant because it creates a structured feedback loop between IRS CI and financial institutions on their suspicious activity reports. The agency is not just passively receiving SARs. It is now actively coaching banks on which patterns to flag and how to format their reports for maximum utility in criminal investigations. Let that land for a moment. The IRS is training your bank on how to surveil you more effectively. And on January 9, 2026, Treasury Secretary Scott Bessent announced a series of new federal actions focused on financial fraud enforcement that explicitly placed banks on the front lines of detecting and deterring financial crimes, with heightened regulatory scrutiny and increased information requests to follow. This is not normal enforcement tempo. This is a structural shift in the relationship between the banking system and the federal surveillance apparatus. And history tells us exactly where shifts like this lead. To understand the endpoint of what is being built, you have to look at the 2 historical moments where governments dramatically expanded their financial reach over ordinary citizens. The first is the Great Depression and the gold confiscation of 1933. In 1929, the United States financial system was operating without the information infrastructure to track private wealth at scale. The federal government had limited visibility into what individuals held, where they held it, and how they moved it. When the banking system began collapsing between 1930 and 1933, with over 9,000 banks failing and destroying the savings of millions of Americans, the government's response was not just economic, it was informational. Executive Order 6102, signed by Franklin D. Roosevelt in April 1933, required every U.S. citizen to surrender their gold coins, gold bullion, and gold certificates to the Federal Reserve in exchange for paper dollars at a fixed price of $20.67 per ounce. This was a forced asset conversion backed by criminal penalties. Refusal meant fines of up to $10,000 and up to 10 years in prison. And here is the sequence that matters. Once the government centralized the gold supply, they immediately revalued gold to $35 per ounce. In a single policy action, anyone who had held dollars lost 40% of their purchasing power overnight. Anyone who had managed to keep physical gold outside the confiscation order saw their wealth preserved and multiplied. The lesson here is not that FDR was uniquely authoritarian. The lesson is that in a systemic financial crisis, Governments with access to financial surveillance infrastructure will use it to control the movement of private wealth. And the access Roosevelt had in 1933 was primitive compared to what exists today. In 1933, the government had to issue a public order and rely on voluntary compliance backed by criminal threats. Today, the government receives real-time data flows from every financial institution in the country without issuing any order at all. The second historical parallel is the 1970s, and this one is even more directly relevant to what we are watching unfold right now. After Nixon closed the gold window in August 1971, ending the Bretton Woods system and severing the dollar's connection to any commodity anchor, the United States entered a decade of monetary chaos that most modern investors have never had to navigate. Inflation peaked at 14.8% in 1980. Real interest rates were deeply negative for most of the decade, meaning anyone holding cash or bonds was losing purchasing power every single year. The Dow Jones, measured in real inflation-adjusted terms, lost roughly half its value over the course of the decade, despite nominal gains in some years. And what did the government do as the fiscal situation deteriorated and debt pressures mounted? It expanded financial reporting requirements. The Bank Secrecy Act, passed at the beginning of that decade in 1970, was the opening act of what became a systematic expansion of government visibility into private financial activity that has continued for 55 years without interruption. And what preserved wealth during that decade was not stocks, not bonds, and not cash in a bank account being eroded by inflation. Gold went from $35 an ounce in 1971 to over $800 by January 1980. That is a 2,200% gain. Silver went from $1.50 per ounce to nearly $50. That is a 3,300% increase. The investors who understood that the monetary system was being debased, that financial surveillance was expanding, and that the rules of the game were being rewritten, moved into assets that existed outside the system being reshaped. They did not wait for clarity. They acted on the structural signals before the mainstream understood what was happening. The structural signals today are louder than they were in 1971, and most people are still waiting for clarity that will arrive too late to act on. Now let me connect all of this to the current moment, because there is a specific mechanism that is accelerating right now that most people have not fully processed. The IRS currently estimates the tax gap, which is the difference between taxes legally owed and taxes actually collected, at somewhere between $500 billion and $600 billion annually. That number drives everything about IRS enforcement strategy because closing even a fraction of it represents enormous revenue for a federal government carrying over $36 trillion in national debt, with annual interest payments now exceeding $1 trillion for the first time in history. The interest on the debt exceeding the entire defense budget is not a projection. It happened, and the political pressure to close the tax gap without raising statutory tax rates is generating an enforcement expansion that is unlike anything the agency has pursued since the 1970s. The IRS has already launched initiatives targeting more than 125,000 high-income individuals who failed to file returns. 25,000 of those individuals had incomes exceeding $1 million. In fiscal year 2025, the agency identified $10.59 billion in financial crimes. That is not a stable enforcement environment. That is a system in acceleration. And the Bank Secrecy Act surveillance infrastructure is the primary sensor network feeding that acceleration. Here's the specific mechanism most people are not aware of. Every financial institution in the United States, including your bank, your credit union, your money market provider, and your brokerage, is required to maintain an anti-money laundering program under the BSA. That program must include internal controls designed to detect and report suspicious activity. The program must be reviewed and tested regularly, and the bank faces civil and criminal liability if regulators determine its monitoring systems were not adequate. What that creates is a powerful institutional incentive for banks to over-report rather than under-report. A bank that files a SAR on a customer who turns out to be innocent faces no penalty. A bank that fails to file a SAR on activity that later leads to a criminal investigation faces regulatory action, potentially millions in fines, and potential criminal liability for executives. The asymmetry of incentives means your bank is far more likely to file a SAR on ambiguous activity than to exercise judgment in your favor. And since you will never be told a SAR was filed, you have no mechanism for correcting the record. Beyond the SAR and CTR infrastructure, the IRS is now deploying advanced data analytics and artificial intelligence to cross-match information across multiple financial databases simultaneously. Starting in 2025 with new Form 1099-DA requirements, digital asset brokers are now required to report your cryptocurrency transaction proceeds directly to the IRS, the same way stock brokerages have reported equity trades for decades. That effectively closes what had been the last significant gap in the IRS's financial visibility infrastructure. The agency can now see your wage income from your W-2, your investment income from your broker's 1099, your crypto gains from the new 1099-DA, your bank interest from the 1099 INT, and any cash transaction over $10,000 from CTR reports. And it is cross-referencing all of that data using artificial intelligence to identify what the agency calls lifestyle gaps, which are situations where your reported income does not match your apparent spending and financial activity. That last category is where the surveillance becomes uncomfortable for a much larger population than most people realize. A lifestyle gap can be triggered by entirely legal activity: an inheritance received and deposited, the sale of personal property, a business-to-business cash transaction in a trade, regular transfers between family members. Each of these can create a pattern that looks anomalous to a machine learning algorithm designed to flag unreported income. And once flagged, the process that follows moves without your knowledge until it does not. Now let us talk about where this ends and what the three asymmetric plays are, because understanding the problem without understanding the response options is just anxiety without a framework. The first asymmetric play is structural financial hygiene, and it is the most immediately actionable. If you are conducting any level of business or personal financial activity that involves significant cash movements, you need to understand what your transaction patterns look like from the outside before a surveillance system flags them for you. That means understanding the $10,000 CTR threshold and the structuring prohibition around it. Deliberately breaking transactions into amounts just below $10,000 to avoid reporting is called structuring, and is itself a federal crime under 31 U.S.C. Section 5324, regardless of whether the underlying money is legitimate. It also means understanding the SAR trigger framework. Banks are required to file SARs on transactions involving $5,000 or more for banks, and $2,000 or more for money service businesses, where the institution knows, suspects, or has reason to suspect that the funds derive from illegal activity, that the transaction is designed to evade BSA reporting, or that the transaction has no apparent lawful purpose. That last category is the one that catches most ordinary people off guard. A transaction that has no apparent lawful purpose is a subjective determination made by a bank compliance officer reviewing an automated flag. If your account activity pattern deviates significantly from what the bank's model considers normal for someone in your demographic, that can generate a flag. Documentation that explains the purpose and source of unusual transactions is not paranoia. It is the only mechanism you have to influence the SAR decision before it is made. The second asymmetric play is reducing your dependence on financial assets that are fully within the surveillance infrastructure. This is where the historical parallel to the 1970s becomes directly applicable to your portfolio. We are in a financial repression environment right now. Real interest rates, meaning the nominal rate minus actual inflation, are barely positive in the United States and negative in several major European economies. The federal government is carrying $36 trillion in debt, with no credible plan for reduction. The primary tool available to inflate away the real value of that debt over time is financial repression, meaning keeping rates artificially below the inflation rate, eroding the purchasing power of dollar-denominated savings gradually enough that most people do not notice it happening in real time. In that environment, the assets that historically preserve wealth are the ones that exist outside the system being debased. Physical gold and physical silver have no counterparty risk. They cannot be reported in a CTR or SAR because they do not exist inside the banking system. They cannot be digitally confiscated. They cannot be diluted by a central bank printing decision. And in every major monetary crisis in modern history, from the 1930s through the 1970s to the Cyprus banking crisis of 2013, they have functioned as the ultimate form of final settlement that sits outside whatever framework governments use to manage systemic financial stress. Gold is currently trading near all-time highs in nominal terms, but it is not yet priced in a full loss of confidence scenario for fiat currency systems under sustained debt pressure. Silver, with a gold-to-silver ratio currently around 85-1 against a historical average closer to 50-1, is significantly undervalued relative to gold by any long-term historical measure. A minimum allocation of 10 to 20% of liquid net worth in physical metal, not paper ETFs, not unallocated pool accounts, not futures contracts, but physical metal in your direct possession or in a fully allocated segregated private vault, represents insurance with asymmetric upside in the specific macro environment we are operating in right now. The third asymmetric play is jurisdictional and legal structure diversification, and it is the most underutilized tool available to individuals with meaningful assets. The surveillance infrastructure described in this video is jurisdiction-specific. It operates within the U.S. banking system. Financial institutions reporting to FinCEN are U.S.-regulated entities. Foreign accounts in properly structured offshore jurisdictions with strong rule of law are subject to different reporting frameworks. Foreign bank account reports, known as FBRs under FinCEN Form 114, are required for U.S. citizens and residents with foreign accounts exceeding $10,000 in aggregate value. There is no ambiguity there, and attempting to hide foreign accounts is the kind of structural violation that attracts serious federal attention. But legal offshore account structures, properly disclosed, properly maintained, and operated in jurisdictions with strong property rights and banking privacy laws, provide a level of institutional separation from the U.S. domestic surveillance architecture that is not available through any domestic structure. Switzerland, Singapore, and several other stable jurisdictions operate under different regulatory frameworks. Precious metals held in private allocated vaults in those locations exist outside both the U.S. banking surveillance network and the reach of domestic capital controls that could, in a genuine systemic crisis, be imposed without warning. The wealthy do not talk about this publicly, but the data on cross-border capital flows tells you what they are actually doing with their money. Now let us talk about the one element of this that nobody in mainstream financial media has connected clearly yet, because it is the piece that makes everything else accelerate. The beneficial ownership information reporting requirement that took effect under the Bank Secrecy Act on December 1st, 2025, requires certain professionals involved in real estate closings and settlements to submit reports to FinCEN on non-finance transfers of residential real estate to legal entities or trusts. This is not a minor administrative adjustment. This closes what had been one of the last significant opacity windows in the domestic financial system. For years, the primary way that sophisticated individuals moved significant wealth outside the visibility of the banking surveillance network was through real estate held in LLCs and trusts. That window is being closed legislatively. The corporate transparency provisions embedded in the beneficial ownership reporting requirements mean that the government now has access to the ultimate ownership information behind the legal entities that hold real estate. And when you combine that with the CTR and SAR infrastructure tracking cash movements, the Form 1099-DA now tracking digital asset transactions, the FBAR requirements tracking foreign accounts, and the AI cross-matching systems connecting all of it, you are looking at a surveillance perimeter that is closing around private wealth in a way that has no historical precedent in the United States outside of wartime. And the pressure driving this expansion is not going away. The federal tax gap, which the IRS estimates at $500 to $600 billion annually, represents the most politically attractive revenue source available to a government that cannot pass new taxes through Congress. Closing that gap through enforcement rather than legislation is exactly the kind of policy that generates bipartisan support in theory and almost no organized opposition in practice. Because nobody lobbies for the right to underreport income, which means the enforcement expansion has a built-in political tailwind that will keep it accelerating regardless of which party controls Congress or the White House. So let me bring this together because the action checklist here is not complicated, but it requires you to take it seriously before the enforcement environment tightens further rather than after. You need to audit your own financial exposure right now. Pull your own bank records for the last 12 months and look at your cash transaction patterns. Are there any transactions that could generate a CTR? Are there recurring patterns that deviate significantly from your declared income in a way a machine learning algorithm might flag? If the answer to either of those questions is yes, the time to understand your situation is before a report is filed, not after. The moment a SAR is in the system, you are operating in a reactive posture without knowing it. You need to reduce your concentration in fully surveilled financial assets. The historical evidence for this is not ambiguous. In every major period of government financial expansion, from the 1933 gold confiscation to the 1970s inflation cycle to the 2013 Cyprus bail-in, the people who preserved wealth were the ones who had positioned in assets that existed outside the framework being reshaped. A 10 to 20% allocation to physical precious metals is not speculation. It is the rational response to a system that is demonstrably expanding its reach and has done so without interruption for 55 years. You need to understand what your bank is actually doing with your transaction data and why they are institutionally incentivized to over-report rather than under-report. The compliance math is not subtle. A bank that files an unnecessary SAR faces zero regulatory consequence. A bank that fails to file an appropriate SAR on an account that later surfaces in a criminal investigation faces civil penalties that can reach millions of dollars, potential criminal liability for senior compliance officers, and lasting reputational damage in their regulatory relationships. Given that incentive structure, your bank will always lean toward reporting when ambiguous. And since the gag order in 31 U.S.C. Section 5320 makes it a crime for a bank employee to tell you that a SAR has been filed, you have no feedback mechanism and no ability to correct the record before a report enters a federal database. You need to understand the legal architecture that governs your money before it governs you without your knowledge. The Bank Secrecy Act, the Patriot Act, the anti-money laundering programs at your bank, the FinCEN SAR and CTR infrastructure, the new beneficial ownership reporting requirements, the Form 1099-DA digital asset reporting, and the IRS's AI-enhanced cross-matching systems are not coming. They are here. They are running. And the operational expansion underway in 2025 and 2026 is not a temporary enforcement cycle. It is a structural upgrade of the most comprehensive financial surveillance system ever operated by a peacetime democratic government. The people who will come through the next 5 years in a position of financial strength are the people who understand the rules of the game being played right now, who have reduced their asymmetric exposure to a system designed to extract information first and make decisions second, and who have positioned meaningfully in assets that do not exist inside that system. Physical metals, allocated private storage outside the domestic banking network, properly disclosed international structures in jurisdictions where the regulatory framework provides genuine institutional protection. These are not fringe positions for conspiracy theorists. They are the portfolio decisions that serious money has been making quietly for the last decade, while the mainstream conversation stayed focused on equity indices and interest rates. Here is what I want to hear from you in the comments. Do you know right now whether your bank has ever filed a suspicious activity report on you? And when you think about your current financial setup, what percentage of your liquid wealth exists inside the banking surveillance network versus outside it? Drop your answer below, because the conversation in this community is where the real thinking happens, and the collective intelligence in this audience is consistently ahead of where the mainstream narrative arrives 6 to 12 months later. If this breakdown gave you a clearer picture of what is actually being built around your money, and why understanding the legal architecture matters more than any individual news story, then do one thing right now. Subscribe and turn on notifications, because this channel is going to track this as it develops in real time. We are not going to wait for the mainstream financial media to catch up. We are going to be here before the clarity arrives, when acting on the information still produces asymmetric results. Share this with someone you know who has significant assets in the banking system and has never thought about what the Bank Secrecy Act means for their financial privacy. They need to hear this before the window for acting on it has closed. The machine is running. The question is whether you understand it before it understands you. I will see you in the next one.